Hello and welcome to my risk assessment guide, the ultimate risk guide for day trading. Now we're going to be doing something very different today. I think the world typically has one way of looking at risk, and luckily with my science and the way that I do my teachings, we're modernizing day trading and we're doing something that has never been done before, which is creating a risk model that has never been assessed in the way that we can use time mixed with the risk assessment model to create the ultimate risk guide. Now, pre-warning, this is using a lot of my science, so there might be points to this video and things where you might not quite grasp what I'm doing, some of the concepts I'm teaching. No worries, there's a simple fix for that. You're simply just going to go and learn my courses on YouTube. They're all free anyways. I have everything from beginners, advanced, and pro level courses where if you're struggling to keep up with this guide, as this guide will be very advanced, you can simply go and learn those pieces that you're having questions about or not quite getting. At that point, you can also think about joining my community on Discord and on Patreon. I have this great, big, huge community that's constantly helping each other out every day, and that would be your next step. So go and take all my beginners courses, advanced and pro level courses, join my community, and then you're fully equipped to talk about these things, understand them, and assess them with your peers. Let's move on to the risk assessment guide now. Okay, with that knocked out of the way, let's talk about the risk guide. Now, the last thing I wanted to do was do baby steps and take a light approach to this. If people are having trouble understanding, again, you can go and catch up with my science on my channel. Otherwise, I wanted to give the most advanced look on this thing as possible. So I've taken the approach of using a lot of terminology. I talk very fast. And yeah, if you're having trouble, join the Discord community. They'll help you out. We'll help you out there. Now, let's talk about what is going to be in this guide and what is not going to be in this guide. What is not going to be in this guide is every single scenario possible. It would take me weeks of recording, and this would be like a 5 or 6 hour guide, which I'm sure people wouldn't mind, but it would just take way too long to go through every single scenario where you would assess risk. Rather, what this guide is how to look at risk differently and create the tool set that you need to start assessing risk in a very different and modern abstract way that is going to help you not lose as much money in the markets and give you a better grasp on every single trade. So it's not going to be the exact set of blueprints for every single scenario. Rather, it's going to be the ultimate toolkit to give you everything you need. So this guide is going to be broken down into 4 sections. The first section is going to be an example of how normally we would look at a move at a high level and we would assess risk, or typically what people would do. So that's going to be section number 1. Section number 2 is going to introduce timing into risk. So assessing risk very differently in a more modern way, and really the core of this guide. So section 2 is the bulk of this thing. It's meat and potatoes behind assessing risk. Section 3, we're going to talk about shields and trades and how you use them and what they are. And section 4 is we're going to go through a secondary example. The first example is going to be in section 2, but in section 4, there's going to be a secondary example also combining now section 2 and 3 together. So risk assessment with time and shields to give you another example of how to use risk. So it's really going to be very comprehensive. You strap in, it's going to be a bit of a long guide. And yeah, let's jump right into it and talk about risk. All I know is that a lot of people look at risk, I think, in a very kind of a backwards way. Your typical risk assessment is going to look something like this. And okay, so let's go like this and just kind of hide everything here so we can just have a clean chart. We're just going to pick a random spot on a chart. Hour, time frame, sure, sounds good. Yeah, right there, looks good. And we'll just zoom this in, and we're just going to pick a hold level to buy. Create a trail, follow the trail. Where's my tools? Here we go. Buy right here, right? It's the first one we see on our screen. Buy right there. It's a hold level. Start diving into the time frame. So you have the hourly there. You have the 15-minute here, which is also the hourly in the same time frame. You have the ladder point here, which if we have no deeper part of the move, the 5-minute there and the 5-minute here. So this becomes like maybe the best part of the range to buy in here somewhere, where you can see if this can hold and not hard close over time, anywhere between the wick and the body of the candle, really not wanting to hard close the body of the candle. So this is kind of your typical position. Somebody will go through the hourly hold level. Maybe this is even onset by a 4-hour. No 4-hour. Deeper in the 4-hour, we have the 1 hour. Deeper inside of this 1 hour, we have we find the piece that can ladder the move prior to this happening. So even if you were to think back to this right here. This in the moment would be, oh, okay, let's create a trend off of this. So let's kind of ladder above that. That would be anyways a thought process that would make sense to me. So then you're going in here, you're finding the backside, which coordinates with the front side as well as this and the 3D hold there. And if you go down in time frames, you can go down into this range or you can sit here. Really, that's not important for assessing risk. All that's important is kind of just creating the logical idea of what a buy could look like. And so fine, you have this here, or we could even just do another one. You could just go to the next one. And if you miss that, you can confirm that, okay, we held the 15-minute level. Let's buy the next one. And so this is, relatively close enough to be considered hit there. That's fine. So get into a trade. And what happens is we start creating risk afterwards. So let's go to this moment in the trade. Well, we're going to go to the first moment because we're going to look at both of these moments. Okay. So this is the traditional way that risk is looked at. And we're going to go back to that 5-minute level that we have right here. Really, it's get this level here. You have a backside here, which can protect the move. It's what broke the move out. There could be an origin in here. Backside protects it, or you could be up here. Really not important for this. Right here, you'd enter a trade. Okay. So we're actually going to go back to even further. Oh no, sorry. We haven't entered the trade yet. We've marked our level and we're waiting to enter this trade. So what we're going to do is just hit play. Let this thing move forward. And great. Right there, we have now entered our trade. Why is that up? Like it's being weird. Blue line is up. Okay, there we go. It's off. You've entered your trade right here. So the normal way people would assess risk is that they would start to draw things like this and say, okay, we've got a trend here to here, like the kind of your typical, way that we would assess risk. We would say, okay, well, where's the highest time frame? Okay, so we don't have the 15-minute yet, so we can't create the 15 yet. But ideally, we would create some kind of trend like this. Ideally, we would have this 15-minute be the final piece of that, because I don't think there's going to be anything higher here, and indeed there's not. So you can go down into time frames and you can deepen your trend like this, and then you can go down into a further time frame, and there's nothing else deepened that you could go to. Maybe at this point you could go like this after the move had happened, after the fact, but really we're not there after the fact. What we have is we have the in the moment, should we buy this hold level? Hits the hold level, can regain trend. We have a 1 minute, data point's not available. Well, okay, so we're gonna have to not use 1 minute candles and remember that. Now we got to go find this mark again. That wasn't too bad. Pretty easy peasy. So great. We've got kind of the way that we would normally look at risk. We mark our levels and we have, trends that we use and hold levels. And if it breaks this part of the move, it's going to go deeper into the range. So then you have kind of like this range splitting from here to here. Would be one thought process would be, if this can't create some kind of range off of this move, then you're going to go deeper in the move. So you've got a bit of a splitting there where you wouldn't want to really be holding a position much past this. Even if you're holding a position past this, how you would look at this, and you'd have kind of this range splitting to say, okay, well, if we're not going to hold this part of the move, right? If you can't establish here, you've got a bit of a difference you need to split down here. And then really you should do some due diligence to see what this was testing back. We're not doing that right now. We're just creating kind of a risk scenario. And then, so you're sitting here, you have your hold level entered on the trade, and you have your trends, and you have everything, and you understand this is the next part of the range down here. And maybe you could even divide it and find stuff in here. If you divide time frames, or you go deeper into time frames, you could find reasons why this may make sense as a 1 minute hold level, a valley, a breakout, an origin, whatever the case may be. But again, right now we're trying to buy this 5 minute level. So we don't really have any risk parameter yet, other than the way we look at risk in this scenario is that we say, okay, it's going to hit this level, and then I need to decide if it's hard closing this. So we've kind of set up a black and white, is very binary, monochromatic response, right? We've set up a very, very much as we have expected outcomes that will either keep us in or out of the trade, right? So it's like, okay, if we hit this trend, yes or no, it doesn't hold. We could deep dive, yes or no, yes. We could not hold trend, no, indeed. We could then deep dive, yes. And then we could hit some type of level and then regain trend. So it's a very kind of this very binary trail of responses, or bridges and switches, as I like to call them. You have a very much, but let's not use bridges and switches, because that's not the right terminology for this. That's something different. But anyways, just a very monochromatic reasoning, very black and white. Just if it hits this trend, if it holds, it goes up, yes. If it doesn't, it can deep dive, yes. If it deep dives and holds the level, it can move above trend, yes. And then these are the things that can lead into succession. So when we enter trades, and this is, I think, the way most of the world will do this when they're doing day trading, is they will set up a situation where you've entered the trade. Yes, so let's get to that moment. We've sat there on a books. We have a limit order in play. Yes, at this point, we now have started kind of this own. You've unlocked the gates to hell. At this point, you have now opened up all the different possibilities for what should happen in this trade. Just broadly, you put out into the universe. Okay, now I need to see if this level hard closes. I hope we move up and gain this level. I hope we get back over top of trend. If we go under trend and start hard closing, we need to be very aware that those time frame hard closes on this trend may indeed impact this move going down and straight down. So we've kind of opened up the gates to hell, where we just are saying, like, there's so many things that we have to watch now. We've put ourselves in a mode where we are now monitoring risk. We are just saying, okay, we can't hard close, or we need to get out of the trade, right? And that's kind of our risk assessment and parameter. You enter a trade, risk assessment happens after, right? So now you're sitting in this trade, you're like, oh, okay, well, you know, we've now laddered below this. Should I start thinking about getting out of the trade? Yeah, maybe, because, you know, we laddered below our point here. Although the break level could be here on a smaller time frame, we've laddered this, and I believe this was the 15 minutes. No, this is the 15 minutes, so that can't be. I believe this was a 3 minute. So now we have, okay, we've actually lessened our time frames, and, you know, now we can do this and see if this can hold like this. And, you know, we're in the trade, and we can go back to the 5. We can't go to the 1, unfortunately. We don't have that much data here. And we can go into this trade and say, okay, should we be in this? Yes or no? And then, so we start adding more models onto this to say, okay, risk gets lower when we gain this, which is true. You know, you want to gain this right here. Dashed line, we'll go gray. That's fine. And we'll go gray for this one. They're 5-minute levels. We don't want to use the wrong colors here. It's going to go for, yeah, like a light gray. This will be a 3 minute. So we're going to go almost white. I like to just gradiate. The white pure is 1 minute for me, and I gradiate these all the way up. So the more gray is like, okay, we're leaning more towards 15-minute levels. And I don't really have a specific one I use for 15. I just know if it's gray like this, it's a 15. And if it's white, it's like 1-3. And if it's kind of in between somewhere, it's kind of like 5-3, or it could be even a 15. So just how I kind of work my colors here. We have a 3-minute level, and now we need to get over this. So then it becomes safe to get into the trade, because now we have sat here and said, okay, we've entered the trade. We have the move we're not hard closing under. We now start kind of assessing risk, and we don't even really assess risk at this point. All we're really doing is saying, if it hard closes this level, we're out of the trade. So we're not really assessing risk, are we? By saying, if it hard closes under this level, we've assessed the risk. We haven't assessed the risk. We've actually reacted to it. To reduce risk, we've had a reactive response. So again, we need to be very clear that this is not assessing risk, because there is no assessment period in this. There's no period where we say, how much risk does this trade have, and what are the things that would alter my decisions? So again, there is no assessment of anything in this. There is just a reactionary point. So we are reacting to data to protect our accounts. And kind of in an arbitrary way, we're calling this risk management, because we are not losing more money by such events happening. So if this event happens and we do indeed hard close our level, we have said, well, we're protecting our accounts. Therefore, we have been trading with good risk management. Well, this is kind of false, because it's not actually, you're not really assessing risk at any point. So I think this is like a really hard line in the sand that we need to define for this month. Assessing risk means that we create risk scenarios prior to trades happening, not while we're in it. Because again, even if you were to go back in time and to, no, we don't want to go forward. That's going to spoil the whole story. We don't know the stories. We picked a random spot. But in this moment, we really haven't put any kind of risk assessment into this either, other than to say, we're buying this level right here. And if it hard closes, we're getting out of the trade. This is not assessing risk. So this is reacting to protect your account, right? So it's just really important this month that we understand that this is a reactive method, and this is not assessments of any type. We're not assessing the risk in any way, other than to say we're protecting our accounts, which I think is a little bit wrong to say that's risk assessment. I think that's just capital protection or account protection, smart trading. If you lose a level, like, why are you holding it until this thing goes to oblivion, right? So this is where you'd be left with in this trade, hoping it goes over this and then using this as a shield, so that you've missed the step. You've missed the risk assessment step in this thing entirely. So next candle, if we get over this, great. We've got a shield in the trade. Fantastic. We can lock up profits. We've set up a good trade. We have bought the hold level and we've used the next 5-minute trail as our shield. And it's kind of a perfect scenario. Go forward a candle. Whoa, that was kind of a nasty snap there. Looks like we've gotten over this and we now have a shield in the trade. So you can get rid of this. You've got your 3-minute trend and therefore you would now assume that you're on a risk assessment module, which you're not. Again, you're just simply reacting to the points that you've set. So this is very reactionary. And so you're in the trade and let's just kind of see where this thing goes. And you know, all things equal, you would say what's happening on this side of the chart. You would go, you know, take your first valley here. Oh yeah, 5-minute was hit there. So your next 5-minute would be right here. And that looks like it was hit. So your next 5-minute would be here. You wick through it. This could be a reverse where you need to hard close. You could even go down to this right here and say 5-minute here because you're just using equalization on both sides, right? 5-minute to 5-minute. If you want to take this as a swing trade, you know, you can justify that differently, but as a scalp, it should just be, you know, 5-minute to 5-minute. So we've hit this here. That has trailed down there. We can keep going here to this 5-minute and your target is hit and therefore the trade is over. And it's like all is good in the world. You make what a great trade, right? Like what an awesome trade, 2.5%. Do that every day and you're going to be, you know, very, very good. So all things equal, this is a very simple trade to kind of scope out a 5-minute trail where we dug down the hourly hold level. We moved it down to what could possibly protect the range before it can go deeper here to the 5-minute. The 5-minute hits, it executes. You know, you're in the trade. It's a little spooky to start with. You're in the trade and it moves up to your target. All things good, right? This doesn't really help us assess risk though in the trade, right? We can just see where this thing goes after. It just continues to struggle with that 5-minute level. Maybe it pulls back to your shield. You know, now, oh no, it doesn't. It just goes up. Well, that's great. Fantastic. You went up. Cool. Maybe we can move this to a 15-minute, just hit play, see if this thing goes up and even further. Then you'd be up in this range here, the 15-minute untested, which you are. And then once that's hit, you've got your trend that gets hit and then it's moving a little too fast. You hit your 15. Next, you'd be at the hourly. This hourly was already hit. So you'd be up here in this hourly. So very straightforward. Also far, we moved from the 5-minute to the 15 to the hourly. It bounced, looks like it bounced off the actual trend perfectly here or whatever, hold level, ladder, trend, it doesn't matter, whatever it is. You know, you hit the hourly and then you're going to see if you can hit the 4. There's nothing left after the 4 inside of the range and you start hard closing the 4. And that becomes your story of this thing moving up. You start trying to hard close this. At this point, it's now created its trend up top, right? We're just doing a little bit of post analytics on this. It's created its trend up top by hitting that, working through its 5-minute to 15 to the hourly to the 4-hour. And then once you've hit that hourly, now you can scale back your breaking point, your point of polarity. You could even scale it back to here maybe as the origin. I don't think so. I think I would just scale it to here. Now you're in that same spectrum where you've hit the hourly here and you're drilling down in this 4-hour to see, okay, here's the hourly. And then there may be possibly a 15 and then a 5 and then a 3. And, you know, you'll end up breaking the cycle over time and you get above this by hitting those levels 15, 5, 3, right? This to here, this to here, this to here. Just by attacking the levels in the final piece of the range, right? Almost, it's a pendulum that swings. Think of it that way. We did the same thing on this side by, you know, finding the hourly, marking it all the way down to the 5-minute, and then the 5-minute has to hit the 5 here, and then it goes up to the 15, and then it goes up to the hourly, and now you have the 4-hour, which needs to hard close, and then inside that range, you're going to divide this range down again to here to break that. So it's just like a big pendulum, right? Like very straightforward so far. I don't know if I'd call it straightforward, but I would say easy enough to follow, right? And then you would start to need to hard close over this because you have your binds on the trade, right? And then so you hard close over that. Now the move is completely changed and you're onto a different part of it, right? So now you've completely moved, changed the move, and you've hard closed this, and now you're somewhere else completely in whatever piece out here you're at. So that's fine. The point of all of this is that there was no real assessment of risk. So let's talk about that for a minute. So let's delete all this stuff. There's just a nice little analytical wrap on that. Let's start to now look at that same move, but with risk assessment. Go to the 5-minute level. Have not gone far enough. Back to here. And now what we need to do is think of this in terms of risk assessment differently. Because in that scenario, what we did is we kind of, again, we don't need to go over it again. We didn't assess any risk in that scenario at all. There was no risk to be assessed there. Now we can look at it differently. Now we can start to build a model that allows us to better understand how we can assess these before it happens. So we need to think of, and I'm going to bring up a picture in case people don't know. I know most people are going to get this, but so we have kind of these sliders, and we need to think of risk as a slider, okay? Whenever we are assessing a position in trading, we need to look at risk differently than the rest of the world does. We need to create something that's faster, better, above it. As always with the science, the real way that we look at things, and not kind of this, the notion of assessing risk after you get into a trade, to me, is beyond foolish. Like, how does that help you in an emergency? How does that help you quantify the risk inside of the trade during it or before the moment's happening to it? How, like, being highly reactive is just almost working on intuition and just trying to, like, I almost see people doing risk, and it's like they get into this trade and they change their mind 4 times before this trade is up. They're like, oh, it's high risk. Oh, I need to get out. Maybe let's just wait for a few more minutes. There's no rules that really encapsulate what your action should be. It's just kind of working on intuition. And when things work out, they're just, oh, I was risking, I didn't hard close. And while we might be using deeper pieces of the science to say, oh, I didn't hard close, so that was a good decision. Well, that's not wrong. That is a good decision. It's just that there was no real risk decisions prior. We didn't really analyze risk in any way, right? So, when you're looking at this trade, you need to start being able to say and kind of put capsules on these things. And I guess you could call them like time bombs or capsules, whatever you want to call them. You need to start putting some kind of parameters on these trades. And we can start doing that with how polarized a move is, right? So we can start doing that by saying, how polarized is this move? And how much of like a gap is there between trends? How much of a gap is there between the next range? So something like this right here, well, okay, we have a hold level here and we have a hold level here. This would be like super risky because it's the final hold level in the move. So we could go down here and say, okay, this one, there's no hold levels left behind it. Well, there might be, but we're not going that far back in the charts. Like, I'm just going to scroll over here quickly. Yeah, there's nothing there, right? So you've got like, this is super risky, right? Like we could already manage this and say like, this is a 10 out of 10 risk. Like there's nothing below it. It's the final hold level. It has to create trend. Like the parameters of this thing become like extremely polarized. So the polarity on this becomes high. So in a risk slider, like if you're thinking of risk as a slider, you would mark this all the way up to the 10 mark up here. Now there's multiple 10 marks, or just disregard the multiple 10 marks. Let's just call this 10 and this 0 down here. So that down here is 0, up here is 10. Okay, so we can say, oh, the risk is super high on this 10. Well, what does that do? Okay, great. Yeah, it's the final level. But here's the magic and what we can do. We can say, okay, because it's such high risk, we know we must higher the risk, the shorter the trade. So if we were to say the higher the risk, the shorter the trade, we know that something that's 10 out of 10, you can't be in this trade for more than a scalp. Every trade starts as a scalp, but this has a time bomb on it. We can say 5 or 10 minutes because the risk is so high. So this gives us an understanding that if we come down to this level, we must make a decision in the first X amount of minutes because the polarity is so high. We are either expecting it to bounce and go up or to kind of struggle to make its move. And as it's struggling to make its move, we can then adjust our risk slider because the longer it stays laddering, maybe that risk slider can move down. So now we have to understand that risk is a slider that we use. We have a first assessment point. So we have like the point of first assessment, which we say, how polarized is this? It's a 10 out of 10. There's nothing left. It's the final piece of the range. It hasn't even created a trend. It's highly polarized because if this were to do this and then fall down to here, it would have to hold to create a trend. So we don't even have a trend under this. We don't have a trend. We don't have any kind of critical levels. This is deep inside of the 4-hour range. The risk on this would be super high. Like you would be 10 out of 10 risk, like your 4-hour levels here. So hitting this and holding this could potentially close this inverse 4-hour rate here. This could potentially be closing an inverse 4-hour level right here. So like you got to sit here and say like the risk of this is, oh, that was the text color. Whoops. You've got to sit here and say the risk on this is ultra high because by hitting this level, you have to create a trend. You cannot hard close under this. Like the amount of things that you have to do to have this be in succession after hitting this is very high, right? So 10 out of 10 means that, oh, I did the 1 minute. Yeah. Okay, let's go back. Give that one a hiya. That's okay. Let's go back. 1 minute charts. I'm so used to relying on them. So when we're looking at this, we can assess risk prior by saying, okay, this is ridiculously risky. So let's take this and let's copy paste this. Let's do that. Oh, okay. This is a level. We actually just need text. Okay, so we can do this. We can copy this, delete that, and put it as a text block somewhere else. The higher the risk, the shorter the trade, right? Perfect. If this is 10 out of 10, it means we must make a decision in the first few minutes. It means we have like a 5-minute time bomb on this thing where if this level is to get hit, we need to see a huge reaction that allows us to develop something thereafter within the first few minutes. So if the risk is 10 out of 10, the shorter the amount of time you need to be in this trade, okay? Let's say this one here. Well, you have a level under it, so it would be a little less risky, but I think it's still pretty risky. Like I would assess this as maybe an 8.5 or a 9 out of 10. I would say it's a 9 out of 10. There's no reason it can't drop to this range down here, right? There's no reason it can't drop in a pretty quick way down to this range here. You know, do we have a 4-hour inverse level? By hitting this, we could be underneath a 4-hour inverse level. So now we can start to check our other information to say, yeah, okay, well, you'll be under a 4-hour inverse level. You can see what's hit on the top. We've already tested the hourly. Is that the trail of information that's been holding us down? Let's see. Hourly here to the reverse here. Yeah, to this here in the future. So this would be like an hourly reverse in the future. You've already hit this. You're not closing it. So you've hit your hourly. So now you would kind of assume that your next hourly level would be here as well before we go and hit that 5-minute level. I believe we haven't hit it yet. We can get rid of this. We can now go back to this 5-minute chart. Oh, shoot. By going through that hourly, we did hit it. Okay, so then the only thing we can do is go here because I'm doing this on a replayer tool. So it's going to skip time frames on me like that. So that's fine. Let's take the replayer tool back to this. So I would say that this is, you know, like it's still relatively high risk. It's still a relatively high risk trade. But maybe we don't need a 5-minute time bomb on it. Maybe because it's a 9 out of 10, we can have maybe like a 15-minute kind of a point on this where we know we need to make a decision in the first 15 minutes. This 10 out of 10, we know we need to make a decision in the first like 5 minutes. But this is just to do an introduction to risk and how we assess our risk in a trade. So let's just go to this trade. It's a 9 out of 10. So we can say we can allow this 15, maybe even 20 minutes to develop because it is not that risky yet. We have a trend here. We need to hard close above it. I think 8.5 was actually correct to assess it. And I think a big part of risk assessment is really deciding this numerical factor because the numerical of this, you know, whether it's a 5 out of 10, if it's a 5 out of 10, we already have the time and the amount of time we're going to allow this to ourselves to be in this trade before we must make a decision. So, you know, you can use trends to aid in that. We'll go over all of that this month, but really in this moment, we've assessed at a 9 out of 10. So let's go with our assessment. Let's add our trend that we would have had in this moment. Let's say we've got a 5-minute trend that we have in this moment. We want to gain back over top of this. We're going to say this needs 15 minutes. So in 15 minutes, we are going to say, okay, the risk on this is relatively high. We cannot really allow ourselves to be in this for more than 15 minutes here. Okay, so things aren't looking great. We've given ourselves, we'll count these as 2 candles, 5, 10 minutes. We have now created what could be the final trend. There should be nothing left after this, and this is even under our level. So this is getting to be a pretty risky situation. One more candle before we make a decision. And all of a sudden, we've got what could be a level developed, right? And we've got this here. So hard closing this doesn't really become important because we're kind of on our last 5 minutes of this trade. We've hit our 15-minute mark and we have 5 minutes left to make a decision. So actually hard closing this doesn't really matter anymore. So now we know where we have to get to in the next kind of 5 minutes. So in 5 minutes, we kind of have to be above this level. And we should use trend now instead of hard closing the level to further adjust this. So now our risk, I would say we're not sliding at this point. I would say we're still in the first 9 out of 10 kind of scenario where you have risk is now associated as a 9 out of 10. We haven't gotten out of this first bind yet. We were able to say prior to this move getting hit, we understand what we need to do in this trade. We've assessed it as a 9 out of 10 because there's still another range. It's not quite as risky as this range. So this is like a 5-minute type of trade, 5-6 minute type of trade to at least establish something that we can backbone the trade on, but it's still quite risky. So again, 15 minutes max. We've done this before the trade. We were able to use our technicals to kind of create at least a parameter, at least a capsule of what we can expect. So, as this comes down, there's 5, 10, 15 minutes. We've created a point of the trade we need to get over. We no longer care about hard closing this because we're more concerned now at this point about getting out of this trade before it fails in the next 5 minutes or staying in this trade. I cannot go to a 1 minute chart because it won't let me. So we just have to skip forward a candle. Good. And our risk assessment has paid off because we were able to say, okay, 5 minutes down here, had we come down here and this is super risky, and it's like, okay, we need to we've got 5 minutes to develop something. So if it's doing this for 5 minutes, you're like, I got to get out of this trade because no longer do you care about hard closing this. What you care about is developing something that allows you to adjust this risk slider, because now that we've gotten over this moment, right? Let's do something here. Let's do this. And what we're going to do now is we're going to go like this, and we're going to say, oh, okay, this is now an 8 out of 10. So what we've done is by allowing ourselves to create kind of this risk assessed module prior to the trade, we've given ourselves an exact expectation of what we want from this level so that we're not sitting here saying, oh, we need to hard close. Once it hard closes, it like a lot of times it just dumps. Notice how a hard close happens, but the dump snaps you out of your position like crazy sometimes. Like the hard close is the dump, right? You know what I mean? I think people understand that. They've seen it enough is that the hard close is the dump. It's like, well, I couldn't get out. The hard close wasn't there and it dumped like a solid 10%, right? Now, instead of worrying about the hard close, you worry about the time constraint associated with the risk. We've now moved this from here to here. We have a shield in the trade. We can now slide that risk from a 9 to 10 and say, oh, we have a shield. So now we can go back to a hard close model where we are locking up profits. And by going to an 8 out of 10, we can now start to adjust this slider to say, are we still in a scalp trade? Are we actually in a swing trade now? And let's just kind of move forward a little bit. Have our shield in the trade. You could either pick to have a target at this point. So you could say, okay, I have a, oh, no, we don't want to do that. You could say I have a target I want to hit, right? At 2%, that's great. Or I have a bind of the trade I want to remove. Let's just sit here. Yeah, target is hit, great. You made your first 2%. At this point, yeah, risk is still 8 out of 10. If it holds up here, you can now say if it holds this, we are 7 out of 10. And I actually need to start thinking about taking this into a swing trade if it holds above this. So now you can kind of get into an interesting part of this where you've hit target, you haven't taken profits, you have this as a shield. And if it holds, you still, if it breaks, you still make over 1% if you want. And you have now lowered the risk here because you're always in profits. And if this holds, you can continue to now move that risk slider, because by moving this risk slider, what you're doing, 10 is a scalp, 5 is a swing, 0 is a position. So now by adjusting your risk slider, you can go and you can start to trade these scalp trades and give them the justification to turn into those higher time frame trades. There you go. You've hit that. Look at this, 7 out of 10. If it holds this, we can now turn this into a swing trade, right? Now we are in that time constraint where there is a swing trade now. Now we can go like, oh, our risk is here. You can pick any one of these levels. For this, I'm going to just get rid of this. Say our risk is here. We can still lock up 2%. And now we're in 6 out of 10. This is becoming more of a swing trade, right? And there's a lot more work to do than just to say, oh, 10, 9, 8, 7, 6. Like this is just a crash course on it right now. This is just, or like a crash introduction to risks. Like there's lots of different ways we work in between 6 and 7 and different justifications we make. But then you can start thinking about turning this into a swing trade and hitting a much bigger target. Maybe, I don't know where our targets were, but let's just pick a percentage target. Let's just go to the range and say 4%. That looks good. Now, so we can just say here, now you're in a swing trade with this as your shield with a lower risk. So now we're in a swing trade, right? And this is how we get into swing trades, right? Don't hard close this. We're good. You can move that risks association up so that you protect yourself. Oh, I hit space thinking it would pause it and it didn't, right in the moment of truth, right when it hit it. I hit the space bar because I'm so used to working in Adobe products. Whenever I need to freeze something, I hit my space bar like, I don't know how many times a day, probably like solid 300-400 times a day. I'm surprised I don't wear them out. I hit my space bar because space pauses After Effects and Audition and all my, this isn't a second hi-ya of the day. So now we've taken risk and we just picked a 4% because I know the range is in here somewhere and I just don't want to go back and find it. We're just kind of shortcutting here. So now we've used risk prior to the move happening to put it in a capsule. And we've been able to hit a 4% trade now by understanding that we can assess risk differently. Using the science, we can create like a really advanced, highly like science dependent risk module that gives you like perfect capsules that protect us even further in trading. So this is what risk assessment at a high level looks like, because we need to understand, and going back to the very beginning of this, we need to understand that getting into a trade like this and having a 5-minute level like this, right? Getting into this 5-minute trade and hoping it doesn't hard close isn't assessing risk at all. It's reacting to the TA, or it's reactionary. It's not assessing of any type, because we didn't assess it in any way. We didn't give this any parameters to help us aid in our trading. All we did was say, oh, yeah, like if it hard closes this, then we have a reactionary method, and that's not assessing risk. That's reacting to trades or reacting to risk. This is like reactionary. This is like account protection, capital protection. It's not assessing risk because you're not assessing risk in any way. So the devil is in the details, and those words are super important, because this is not. I think people can see now how that, like, this doesn't assess risk in any way, because all you're doing is reacting to protect your account. That's not risk assessment, right? So this is risk assessment, where we can pick levels and say we have to think of risk in a way where we give it criteria that allows us to assess how long we should be in this trade. It allows us to assess what we should expect. At what points should this trade break down and take us out of the trade. And again, we just picked a random spot and used some risk modeling, and we were pretty accurate on it. To say what makes sense as a swing trade, what makes sense as a scalp trade, where your targets, and like it was perfect. And it was all just because we assessed it by risk and not by the actual TA. The TA gives us the levels, but the risk really gives you the smart points in the trade. And then like our target was hit here, and we didn't go for it at any point, because this is a point in the charts that would have a larger pullback, and you would look for re-entry after this target is hit, right? And that all starts with this assessing this as risk, and this as a 10, and this is a 9, and that gives you a capsule of time that you need to be in these trades. So a very different way to look at risk that is high in assessment, low in reaction, right? Ulterior to that. I think the rest of the way the rest of the world does it, I think the rest of the world looks at risk is, yeah, like how I explained it. But this is a very different way, but in my mind, a very advanced way to look at risk, and kind of how I've always looked at risk. And when we're talking about risk and trading and how we can, defer risk, this is, very different than what I think people will be used to. This is how people need to start thinking of risk to assess it prior to the trade happening, based on the fragility and polarity of moves that allow you to put a time constraint into how we need to look at risk. So by putting a time constraint on risk and an expectation, we create a model that we tackle prior to the trade being hit. So prior to us entering this trade, we have a criteria that we know we must follow, and not a hard close. Now we have two criteria. Hard close can work. If you hard close here, this can be an exit criteria. Now time, I don't know how well I can draw a clock here. There's the hour and minute hands. So now we have the hard close criteria. This is really bad. Now we have hard close, and now we have time. So we have two criteria, and now how we react to risk, not just one. And we're able to assess this beforehand, which is the coolest part about it. Okay, let's now talk about shields. We just finished the first two segments of the risk guide. Now we need to talk about shields and how they play a role. So a shield is something like that. A shield is something that protects us in our trades. And that's really why we use the term shield, is because it's a shield for us. It's what protects us. So as trades develop, we also need to develop what's called shields in the trade. If you were to take a 4-hour level, simply mark it right here, you'd have certain shields that are associated with this trade. So for example, as time goes on, a shield can be a trend, a shield can be a level. Let's say we wanted to buy this 4-hour level here. That 4-hour level hit, great. Oh, look at this, we have a trend now. Trend can act as a shield here. So we're going to color code this to yellow since it's a 4-hour trend. And really, we should be starting from the highest time frame down. We should be going daily down. But in this example, we're just going from the 4-hour down. So let's not worry too much about working from the highest time frame, other than that we are starting on the 4-hour because it's convenient. It was what was on my screen when I started this. And that's perfect. So a shield in the move is something where you enter a position and you need to start creating different parts of your move that can indeed be a shield. So a trend, for example, could be a shield. In this moment, in this trade, we could go back and these are 4-hour candles, so they're going to be quite large. Maybe we could go back to this exact moment and see how we could develop shields in the trade. Now, again, the idea behind a shield is that we now create something that can protect our trade. So an example of a shield would be going like this and saying, hey, we have a 1-hour level here. If we gain this level in the future, this could be the 1-hour shield. So if we enter here in the 4-hour trade and we wanted to make sure we stayed above this 1 hour, it is a shield now for our trade. In this moment where we have the 4-hour level, we can see that the move moves slightly beyond the 4-hour level. And now trend in this moment is really our shield. And we can go down further because I don't think using just a 1-hour time frame would do as justice if we were trying to take this trade and we were in this thing and it's like, oh, wow. 1-hour time frames, one candle at a time, an hour later. Yeah, I think you're going to get some pretty bad scenarios. So we have our first shield on this trade developed. So we have nothing on the 15-minute yet, but we do have a 5-minute shield here. And I wouldn't call this the first shield. So I want to point this out right away that we don't work backwards to develop shields. In fact, this can't be the shield. How could it if we are working from time frame up? In the moment when this happened, it would have happened in this 1-minute moment here. You would have hit your 4-hour level once. Ideally, you would have needed to get over this point right here. So we can rewind this a little bit and pretend like we just hit this 4-hour level. We bought it and really we would have needed to get over this, at least in order to create even a hold level. So we need to get over top of this or not to hard close this level. And we don't even have a trend yet. So you come down, you move down into the move. We can assume that our shield is now right here, meaning we have to get over top of this. And if we were to use these time frames, we can kind of go up and see that, hey, this was the creation of that 1-hour trend as well. So we could actually create trend in this moment and we could go ahead and create a shield in the trade, which is here. So we would actually have two active shields here. We would have this trend as a shield to our trade, shielding us from breaking through this trade. So when we lose this trend, we've lost our shield and the trade is done. Or we could have entered this trade on this 4-hour level here, and we need to get back above this. This is the shield to our trade right here. So this level right here acts as the protection to this trade. So if you had entered on this trade, you can say, well, my shield is right here. And if we hard close that shield, I can be out of the trade. So anytime we enter trades, we kind of have to create these protection mechanisms. We cannot create mechanisms that look like this. You have a 4-hour level, so let's hard close the 4-hour time frame. Well, you might be all the way down into no man's land by the time you close that 4-hour time frame, because 4 hours is what you're talking about, 241 minute candles. That's a lot of 1-minute candles. That's not reasonable to say, hey, let's hard close a 4-hour level 240 candles later. Right now, we were able to say, here's our trade, and we need to get above this to create this as our shield. So we can give ourselves some kind of account protection. So great, we have now given ourselves the shield to the 4-hour level. And this is really how we have to look at all trades that we take. We have to start to develop some kind of criteria that once we're in the trade inside of profits, we need to be able to say, okay, this is kind of the breaking point and it's the shield to my trade and what can protect me moving forward in this trade. So that's great. We have a 1-minute shield developed. So let's, before we go any further, put 1-minute shield, and we're going to be using this same kind of copy paste formula here in the next few. And we can now move up in time frames. And the reason why we're moving up here in time frames instead of down, how we usually work with our science down, is that we can't work down if those events haven't been created yet. Rather, we have to work up to create them in the moment. Aha, you see now we have another shield here. We also have a 3-minute shield. So it's getting stronger and stronger in the move. So now you can sit here and say, okay, you've got a 3-minute shield. So maybe this might be a scenario where you come down to this 3-minute shield and you have a hard close right here. You've broken your 3-minute shield, but you haven't hard closed the 1-minute shield yet. You've hard closed this 3-minute time frame, but guess what? You don't hard close the 1-minute. So you run into a lot of scenarios like this where you have multiple shields and one of them will break, the second one will hit, and that will end up breaking and hard closing. And you've got your last shield in the trade. And maybe you even go and kind of sit here, go way down and then way back up all within 1 minute, but you haven't hard closed that last shield. So you can still relatively be in this trade with a certain amount of safety, knowing that this hard close right here, it protects your capital because you entered right here. Yeah, it went a little lower to hit that trend, and that trend can be a shield as well. In the bigger time frames, as we move out and as time goes forth, that can be a different shield in this trade. But for now, we've got a 1 minute shield, a 3 minute shield, and let's see what else we can develop here. We've got a 5 minute shield as well. See, we're starting to gain all these hold levels in the moment to create a variety of shields that can protect us in this move. Let's go to the 15. What do we have on the 15? Okay, now we have our first kind of big boy on this chart. Now we have our first big target to get over and to create a 15-minute shield. So we kind of have all these shields in the trade and what we're kind of expecting this thing to do and where to go. And it really gives you a great way that you can start thinking about protecting your positions after you enter them. And if all your shields break, then you should start to really think about getting out of this trade. So we're starting to get under this 5 minute shield, and we're kind of just walk through this thing. You hit your 3 minute hold level, your 3 minute shield. I would wonder in this moment if you had closed the 5 minute shield. Now we can immediately see that the 5 minute candle right here at 9:51, well, actually this would have been the first candle in that 5 minute candle, because that 5 minute candle would have been created at 1950 and would end at 51. So in this moment, you actually don't hard close and lose this 5 minute shield. Rather, you just hit your 3 minute level or your 3 minute shield, and you haven't quite lost the move yet. So we can continue to move forward in this trade and see where things go. At this moment, it's 1955. We have now opened up the candidate for a new candle. This one could, in theory, hard close. So we've got 4 minutes left. It's 1956, and we've got 4 minutes left. So if we start to sit around here in this moment, you can see how quickly this may lose its trade, as it's looking like it's going to try to break down in its move. But it hasn't quite lost its 1 minute shield yet. There it lost its 1 minute shield, and let's check all the other shields here. We haven't hard closed our 3 minute shield yet. It looks like this candle is hard closing it. The 5 minute shield has not hard closed. So that's it right there. This 5 minute shield hasn't hard closed yet. So this is a scenario you get into where you have multiple time frames that haven't hard closed. Because if you were to simply remove everything else on your chart, you would see that you don't actually have a hard close on this 5 minute candle. You step forward, you probably lose it. Yep, you do lose it right there. And we can go back into this, kind of go back to zero here, and now create kind of like the next set of expectations. You're on your 4 hour level. Remember, we haven't hard closed it yet, and we're still not hard closing it. And now you can start to readjust these, and you can put your shield here. This is still well above your 4 hour level that you entered, and you're still in a position where things are still okay. You haven't hard closed this 5 minute time frame yet. You can now recreate some of these shields. This 3 minute shield will hopefully exist in the same point as this 1 minute shield. We're going to just kind of float it a little bit over top of it, just so when we go into the 1 minute time frame, we can see that there's two shields here. And that 5 minute will now exist. Well, it's actually still existing here. So we're okay here to move through this trade and see as to where we would have had a 1 minute hard close and a 3 minute hard close. Well, we didn't release the constraints of all of the levels, and therefore we haven't removed all of the shields in the trade. So this is really what you have to think about when you're creating shields. Pieces of moves that can help you stay in trades, shields that will show you where the trade actually still exists. And so we don't have a trend here yet. We can make one right here. We have our first 5 minute trend. Great, we have one right there. And that's looks like it's going to not be the 3 minute yet. And we can just kind of walk through this move now at this point to see what happens. Move down to your level again and be here. Hadn't hard closed your 3 minute yet because that was created in this moment. You never hard close your 1 minute level and you're still in the move. So again, you can see how valuable shields can be because they can allow you to stay in moves, and it still gives you those points where you haven't hard closed. So really when you're thinking about risk, this is the part of risk where you have to start creating and adapting the components of your trade to give you kind of these, and we can move all of these down here. We're going to move this one. We're going to move this one. Going to move this, and we're just going to float these for a second. But you're really creating kind of like these protection mechanisms. And again, why I like to call them shields, because you're creating protection mechanisms to allow you to make decisions where you either want to stay in a trade or you don't want to stay in a trade. Again, so we don't have a 15 minute trend. We have a 5 minute trend. We can't hard close this. Let's go like this, and let's put 5 minute shield. It's a trend, and we are going to color this gray. And we know if we hard close this level, well, we need to be out of this trade. And do we have any 3 minute shields? Yes, we do. We have this one here. So we've created this shield here. And we could possibly have a 3-minute trend as well. So we can create this one. You know how we're going to do this? We're going to copy and paste this one. So we shortcut the actual text. And so you have a 3-minute shield, a 5-minute shield. These are two trends, right? Got a 3-minute right there, a 5-minute right there. You've got a 3-minute level here. And what about a 1 and a 5-minute? Your 5-minute will be up here on this trade, and your 1 minute, well, that would be right here, your 1 minute. So you've got a 1 minute, 3-minute, 5-minute, and 5-minute. So if you were to remove all of these constraints, well, it would be pretty appropriate to get out of this move. And now I don't want people to think that you just constantly create 5 and 10 shields on your screen and it has to remove every single shield. This is always a choice of style between comfort. If you're comfortable enough to stay in a trade because you think it's holding a larger level, I think in this case and scenario, where you're talking about it's trying to hold a 4-hour level here. So this yellow level being a 4-hour level, it is going to take time to hold this and develop its move. It's not like it's hitting a 1 minute time frame. Maybe this down here ends up being the hourly part of this time frame, and so forth, and different things. Or maybe, you know, the 1 hour was right here and this is a 15-minute, and maybe this is even a little deeper, it's a 5-minute. So you've got all sorts of things inside of this 4-hour range from back here that go all the way back into the earlier parts of this chart. But really the important thing is that this is a 4-hour level. And it could take time to hold this level. So it's always appropriate to create some type of protection mechanism where you say, I'm in a trade from here. And, you know, it went a little bit under what I thought it would go. Come on, right there. It went a little bit under what I thought it could go, actually quite a bit under. And in order for me to stay in this trade, I need to have some kind of protection mechanism. Now, we're not talking about assessing risk like the risk assessment guide tells us in section 2. What we're talking about is using shields in a trade. And we're going to combine this with risk. So again, this is not the complete picture. Rather, you just have to think of this as creating shields in a trade. So now we know if we start to remove these binds, you've got the 5-minute hard close here, you've got a 3-minute here, you should just get out of this trade, right? You've got the different levels down there that you need to get out of, and really acts as shields. And we're not hard closing anything yet, so we don't have to worry about this. Let's see where this thing goes. This candle could potentially hard close. So now what we have to do is we have to go and say, okay, what shields did this remove? So at this point, we're at a 3-minute. It took this one off. So we don't have this shield anymore. We haven't gained this yet. So this was optimistically put there to say, hey, that could be a 5-minute part of the move. Here's your 1 minute. Have you hard closed and lost this 1 minute? You have indeed. And you've lost this 5-minute trend, maybe? Not quite yet. Not quite yet. You do actually in a moment here, you lose this trend. So the only thing we're left with here is a 3-minute shield. So now we can go into this trade and see if we release this shield as well. So there's a hard close candle here. So we can check the 3-minute. There's no hard close on the 3-minute. This 3-minute shield is still in play. It's kind of the last thing that's holding us up. We have no shields left. So let's take a look at how much time we have left, because that's always an important consideration. So this closes at 2012. So if we go to this move, 2012, it closed here. So this is the candle that needed to close. So it has to close 3 more candles. This is 1. It needs 2 more candles to close underneath this trend. And if it does close 2 more candles and create 1 more 3-minute level underneath the shield, we blow that out of the water. We get out of the trade. The shields are removed. There's nothing left protecting you in this trade. And that's the way you have to look at shields. There's 1 candle. Uh-oh. This is 2 candles. Not quite hard closing. Not hard closing, and it moves right back up. Okay, we're not quite hard closing this 3-minute level yet, right? See what happens here. Holding this 3-minute level. Has it created anything bigger yet? No. Has it created a 15 yet? No. Hasn't created anything bigger yet. We still have 1 shield in play here, and we can just hit play and let this thing go a little bit, I think, because it looks like we're over top of trend now. And you can see how this 3-minute shield protected the trade. And now you would have a bunch of other criteria that you would reset moving from there forth, like such as this being the 1 minute, this being the next 1-minute shield. You have your 1 minute right here, and you would just continuously re-sculpture and rebuild these shields. And you know, even now this 3-minute shield would likely change to a 15-minute. So you can see how shields over time eventually end up being larger and bigger components to a chart, and you break down. And I'm wondering if you had lost all your shields and that was the point where you actually broke the trade. So this is always a really good way to look at trading, is by creating shields for trades to see where something is going to break. As traders, we always need to take any part of our chart. You just hit play here and this thing goes into a little bit of succession, probably goes up from that point on. As traders, we always need to create shields in trades, right? If we were to take this move back to here, you could probably find that point where this thing breaks and 15-minute hard close. And, you could go and rework the chart here at this point. But the most important thing whenever we enter a trade is that we create shields in a trade. So if we were to just go to the current part of Bitcoin and just do a current example, just something that, oopsies, let's go get our Bitcoin chart back up here. Great. And if we were to just go to the current spot in Bitcoin and just do like a very quick thing with shields, what would you do? Well, you would start to say, are you in a long or a short, and where would your shields be? So if you were in a short from up here, you could say, here's the 1 hour shield, right? Like here's the part of the move, the final hold in the move, or at least the 1 hour hold level. And really the benefit of this becomes, if you've entered here, where do you exit your trade? So there's your 1 hour shield. Let's kind of just duplicate this recipe here. You've got a 15-minute shield here. And when you lose this 15-minute shield, if you were short from this period, you might want to consider getting out of the trade. So it's always something that protects you. And again, shields can be levels, they can be trends, they can be anything that protects your capital in a trade. So therefore, you have shields. Okay, now that we talked about shields, now that we talked about how to assess risk, let's put it all together and how we use shields and risk to kind of complete all these different types of trades. So first, let's just mark our levels here on the chart. This is a weekly level. Maybe we should start with a monthly here. No need to start with a monthly. We don't really concern ourselves with that here. Weekly hold level was hit right here. Let's see where the next part of this trade would be. Let's go into here and start finding different time frames. So you'd now have a 4 hour level, and let's color code these. So this was the weekly, right? This was the 4 hour level that Bitcoin likely hit. Let's see if there's anything deeper in that range. So what we always want to do first is kind of move through this range. So because this is such a strong level, we can already start our risk assessment, because the point of this is now to put it all together to show you how you can use shields and timing as kind of the ultimate perspective on risk and how to assess risk. Because this is a pretty safe part of the move, I would rate this more of like a 7 out of 10. While Bitcoin is trying to break out, I would rate this, yeah, somewhat like a 7 out of 10. I think you would need to allow this to develop time because of the level it is. It's not a 1 minute level where the polarity is extremely high. It's a 4 hour level. I would maybe even take this as a 6 out of 10. And then really, you know what, when we're using these scales like 1 through 10, right? So 1, let's just go 5, and let's go 10. So like kind of the 3. Let's not include 4. Let's not include 2, 3, 4, 6, 7, 8, and 9. Let's just go 1, 5, and 10. So 1 would be, the ultimate position trade. There's no risk associated with this. The 5 would be a very high potential swing trade, and 10 would be like the scalp trade. It's very high risk. It's high polarity. So we can do like this. We can say this would be subject to high polarity positions, high polarity like this, right? And this would be I wouldn't call this high polarity. I would rather call this far away from, I would say trends or levels. Far away from trends or levels. And I would say this would be no risk of breaking. No risk of breaking. So really we assess risk as a point like this. And in between 1 to 5 would obviously be the various colors of how close you are getting to no risk of breaking as you move from 5 to 1, or as you move from 1 to 5, how much closer you're moving to trends. So an example of that would be, let's find the trend here. So you have kind of a daily range trend like this. So we can make this red. This is a daily range trend. Okay, great. We've got a daily range trend. Do we have anything? Oh, that's actually a weekly. Oh, my mistake. We got a weekly range trend. Wow, that's a big trend. So we can work from this down, and I would look at this and I would start to say, okay, well, this is pretty far from trend. We've got quite a bit to go. So actually, this isn't risky at all. If we were kind of in this moment trying to break over top of trend and saying, hey, we're breaking over top of trend. We haven't hard closed yet, but the potential to break over top and hard close this trend is coming in the next day or two. And this is a weekly range trend. This would be very high risk entering over this trend. Okay. So we're going to go over that in a little bit here. We're like how to do this with trends. But for now, what we can do is we can just say, yeah, you know what? We're not that close to breaking a trend. we can consider that to reduce risk in our formula here. Now we can go and we can mark, this would be the daily right there, which connects to here. So we can actually just mark this daily point like this to there, like this. So now we have kind of shortcut the daily in a way, as this would be connected to here. It's going to be almost the exact same reading if you go from here, as this would have been the daily to there. And then this connects that to that legacy, global, local, like this. So we did a little bit of a shortcut. So I'm going to leave that on the screen to illustrate the risk factor here and how we could look at trends, right? So you have two kind of trends that are starting there. You've got your trends set, and these are both dailies and weekly. So let's talk about this part of the trade first. Okay. So the first part of this trade, before we go to the current time, we kind of have to build back on this thing so people understand risk properly. So in this moment, we need to look at risk in one certain way. So we would be saying, and actually, you know what? Let's go to this right here so we can walk through it. So let's now find the hold levels inside of this right here. So you have your first hourly hold level, and this was hit. So your first hourly hold level is hit here. So let's not use that because it's already an event that happened. And let's go deeper into this move to the point where we can find the next hold level. And this 15-minute hold level really is already hit too. Is there anything on a 5-minute? Okay, there's a 5-minute hold level right here, right? And so we're just going to mark this as 5-minute, and we're going to change the color to kind of a light gray. Let's go to the 3-minute. Is there anything on the 3-minute here? Not really. There's something deeper, but I'm more comfortable with that 5. What about 1? Is there kind of like this extreme polarity moment where it's a final hold level on the move and there's nothing really left? Yeah, you've got this right here. It's very close. We can just label this as the 1-minute. And now we can start to assess the risk of this move going forward. We're going to go to a bit of a higher time frame here. And we can say that, how would we rank the risk of these trades now? I think you would say that anything above this trend is extremely risky. I think you're 10 out of 10. So if you have to start with 1 point in this trade, let's just mark a random point and say this is 10 out of 10 risk, then I think that has to be the point that's above the trend. So I think this is a really good shift for people who are at an advanced level in day trading with my science to start to think of polarity in a different way, because we have to think of polarity as the 10 out of 10. There is only one 10 out of 10 scenario in these trades. And that becomes a very high risk scenario, the highest risk against the range. So we already know that this is kind of the range right here. So this becomes the highest risk in that range. So if we were to say, you know, your range exists like this, and we're going to just kind of change the color properties a little bit here so we can see. If inside of this green box is where your range is, you have to say, where is the riskiest part of this? So this is always about comparatively analyzing the current architecture of the move. And we know that we have a 1 minute here and a 5-minute here. Beyond that, we are trying to not hard close this weekly level, and that we have a trend that's been established. So we don't want to hard close the daily trend above this, which means this can't be the ultimate risk. It means that there's a higher risk part of this move, while this may still be in the range and going above this point here, right? Let's just delete that for a second. Going above this point here, while this might look like it's no longer laddering, you still have to hard close above this trend, which is the point of this move, where you would say, okay, hard closing above this becomes the riskiest point. So the riskiest point would be you get above this trend, you create some kind of 1 minute hold level like this. And as the day goes on, you're getting closer and closer to hard closing that trend, and you break above that. That would be your kind of 10 out of 10 risk scenario, where you're already above trend. You don't have any hold levels after you've broken over trend and you create your whatever hold level. You don't have anything left. You have that hold level. You're already above trend. You're past the range. You're past the ladder point. There's nothing holding you back before this thing completely breaks out of its mind. So we can't automatically, we can't give these a 10, even though they might be the last part of the range. But what we can do is we can give anything above this trend. Basically, the idea is that floating above this trend is a 10 out of 10 risk. So we can give this a lower amount of risk, and we can say, yeah, okay, maybe this 5 minute is I don't know, like 8 out of 10. It allows us to maybe sit in a trade for a little bit longer than a 1 minute candle before we have to make a decision. And I really don't think we need to use this 1 minute candle. I think at that point, using this 1 minute candle, the 5 minute breaking is not really going to hold you back in any way. So great, there's your 5 minute level that gets hit, and that's perfect. It allows you to stay in the trade, and all rules of our risk guide are fluent and have been followed. If you were to use a 1 minute candle here, you might want to make a decision in the first few minutes. Because we haven't assessed this as a 10 out of 10 risk, we have more than 3 or 4 or 5 minutes of a time bomb, because really this 8 out of 10 represents the amount of time that you need to be in this trade, or the time left in this trade. 8 out of 10, I think we can reasonably stay in this for 15 minutes. Yeah, again, not a hard set rule, but you know, as a 10 out of 10, a hard set rule could be like 5 minutes or less. So 8 out of 10 could be anywhere between, 10 and 20 minutes before we have to make a decision. And typically you would see this and you'd be like, wow, we're, no hold levels here, because, the only hold level holding you down would be this one here. In this moment, it get created, it moves up to the 5, creates this hold level, you're hard closing over it. Without using a risk assessment module, you would just be sitting here saying, like, we got to get out of this trade because this is obnoxious. Where this is bonkers that we stay in, this thing's about to pop, right? But it's not a 10 out of 10 scenario. So just using risk alone, we can assume that we have a bigger amount of time. If this thing was to sit here for another, 15 minutes and go like this, then it's kind of hit your constraint here. You've released your time bomb criteria and your whatever you're encapsulating this as. And you can get out of this trade if it sits there and lingers there. And that's the beauty of this, is that it gives you a time constraint instead of saying, hey, we've lost a level, and really allows you to justify that trade long term, right? Which is great, and that's it. This is completed its risk profile. You're in your trade, and then you can make your decisions from there. Let's move forward in this trade now. Let's see if this thing breaks over trend. I actually don't know if it does. Oh, this thing had a huge pullback. Great job on our risk assessment, right? See if, okay, actually, yes, it does. Okay. So, okay, now we're in it. Now we're in this. Let's move forward a little bit here. Okay, good. Just want to make sure it doesn't come back over. Now you're in that 10 out of 10 risk scenario. Now you've gone past this 5 minute. That trade is done. You've already used your risk module for that. This is a 10 out of 10 scenario, right? This is your 10 out of 10 scenario where you are starting to hard close over top of this trend. So this marks that first hard close right there on the biggest time frame available. So there's no hard closes on the 1 hour, which means there can't be on the 4 hour. You go down in time, you find that 15-minute candle, right? That's the first hard close, as you can see right there. So now you have to kind of find that point in that trade that creates that final polarity, right? Because this is your 10 out of 10 risk scenario. So now as you go, you've got, 5 minute here. You've got a 3 minute inside of that, 15-minute right there, and you have any 1 minute. So this is it. This is really it. This is your 3 minute level. It's the greediest part of this trade. And once you take this short here, and you even if you miss this short, you understand that this only has 5 minutes you're allowed to be in this as, because it's a 10 out of 10 risk. Because you know what? As the day goes on, there's nothing left. You're getting closer and closer and closer to hard closing this move. You take this trade, let's zoom in here. You take this trade, you have like 5 minutes before you have to establish your next part of your trade. And the next establishment of your trade would be saying like, okay, I've developed a 5 minute shield. There's no 15-minute shield. The 15-minute shield is down here. So we can go and we can do it like this, and we can say 15-minute shield, right? 15-minute shield. And this one here, right? Good. And then this one here, we're just going to copy paste, so I can do it the lazy way and just delete one character instead of retyping it all. Go to a 5-minute shield. And really, we understand that once we take this 3 minute level, right, the 10 out of 10 risk, you have like less than 5 minutes that this thing needs to develop something. Hits the level, you're in the trade, 1, 2, 3, and you've already created your shield here. So you've already created your shield, and you've already given yourself that point where you can say, like, this is already 10 out of 10 risk. So rather, what we're going to do, instead of having a 5-minute shield, we're going to delete that, and we're going to move this to here and say, okay, 10 out of 10, 5 minutes. We know this is a 10 out of 10 risk, right? Or at least it's starting to build up a shield that you can hard close, and it never hard closes it, giving you that ability to stay in the trade, but also falling underneath the entry criteria of being a 10 out of 10 risk scenario. You have 5 minutes in which you're allowed to stay in that 3-minute trade. So going back to here, you have exactly 5 minutes once this hits. If it can't develop a move, get out, because that risk, you've assessed this risk prior to the trade happening. You've assessed this risk, and you understand that this part of the move, if you are entering this trade, you have given yourself 3 minutes prior, 3 to 5 minutes prior to this level being hit. So if in 3 to 5 minutes you don't develop a higher piece, get out of your trade. If it cannot create a hold level on a higher time frame, you get out of your trade, because that is where you can proactively assess risk and create a model before it happens. So now we've really been able to break this down, and that's a 10 out of 10 risk scenario because it is over top of that daily level. Like we talked about, you're running the risk of hard closing and breaking over top of something much larger and much more important. And then the move collapses. So, we don't need to really talk about what happens after, other than to create that risk scenario to allow us to either stay in a trade or decide if we want to exit that trade in that time. So with that said, let's go to the current part of the move. We assessed one part of risk in this, and let's just see if there's any other kind of moves, because I think the point of this was to find if there's another greedy part of this trade. So we have the 1 hour right there, right? We can take our risk off because we're not entering a trade. Let's see if there's any 15-minute levels. Let's just see what we have for levels. Yeah, you have a 15-minute level right here. So 15-minute. Just going to take the word shield off. There's not a shield in our trade. The shields would be the 5-minute levels and the hold levels that develop in the moment. You have to use that 3-minute back from here. You have to use that 3-minute entry to give you that 5-minute shield. Let's talk about the shield actually before we move on. So in this trade, when we were here creating this 3-minute level, kind of our time bomb scenario where we assess risk based on time and not based on levels, we know we have to create a 5-minute shield, right? So this, what is a 10 out of 10 ends up being the 5-minute shield right here, right? So, and we did illustrate this. I just want to really drive this home that this is now your shield. So if you hard close this on the 5, that risk assessment was already here. You already broke those constraints, right? You already hit your level, and now you've created your shield. So if you start hard closing over this, you're not worried about the stuff in here, right? You've already risked that as a 10 out of 10, right? So yes, that's where you use your shield. And then this allows you to enter the trade and justify whether you should stay in it or not, that 3-minute level. And this allows you to say which level is shielding your trade. So you can exit without taking losses. So that if you've entered here on that 3-minute level, right? That 3-minute level, if you've entered there, this allows you to say, hey, if we hard close over this, we need to get out because this is going to be breaking and we are going to start losing money on the other side. So 2 ways in which we can now manage our trade. So you have to almost think of this as, prior to this guide, you're working in one dimension. You're working in the dimension of technical analysis only. With risk assessment, you're working in 2 dimensions. So now you're really starting to get into the development of what we call comparative analysis, which is the future of day trading. The comparative analysis is what I created and why I called it CA, is we work on multiple dimensions of analysis. Prior to having a risk assess module, you would just simply work with your technicals and say, hey, this one is hard closing, X is hard closing, and we need to get out. This is a very one-dimensional take. Now, instead of just a one-dimensional take where we can say X is hard closing, we need to get out because, again, just like we talked about earlier in the guide, sometimes those hard closes happen like this. Oh, it hasn't hard closed yet. It's lingering around here. 2 more minutes, and then 30 seconds later, and you're up here. Already liquidated out of your position. Technically, there's no hard close, and then you go back 10 minutes later, and this hard close is like the size of a skyscraper. Now you're operating in 2 dimensions. You're operating under a constraint of time and a constraint of technical analysis. So you've just increased your ability as a day trader to operate on multiple dimensions of a chart. So you're now using comparative analysis and time to justify what could let you exit a trade, right? And before it would just be like this. TA allows exits of trades, right? That would be one-dimensional trading. Now, CA allows exits of trades, which can then be broken up into TA plus assessing, right? Or assessment of risk, assessment of risk. So TA plus time, we've used time to assess risk. Now we have 2 dimensions or 2 criterias that we are operating on, allowing us to protect our position instead of just saying, yep, here's a hold level. We closed. Let's leave the trade. This is purely technical analysis. By assessing risk prior to this trade happening, we give ourselves a different criteria that we can exit this trade on. Not much to do with technical analysis because technically we haven't hard closed this level yet, so we should actually be in this trade still, but we are using now a different dimension of trading to justify the exit of that trade, which is the dimension of time, which is so very important in trading. Now we're working as 2-dimensional traders and therefore unlocking a part of comparative analysis moving forward where we don't just use levels, because levels don't always tell the whole story. While they do tell the whole story, there's a different and a smarter way we can protect ourselves. So now let's move forward in this thing. Found a 15-minute level right here in the future. a 1 hour, and a 4 hour. So now we can actually go to, and maybe even we can mark this 5 minute. I don't know if this gets hit, but let's just press play and see. That gets hit, that one. So we don't want to use that. That gets hit there, and then also follows a trail of this hold level into this hold level, and so forth and so forth. And then this would just be that 5 minute level inside of that range. So great. You kind of created everything we needed to create. This is the 5 minute level. This is the hourly. You can just go 1H. We don't need the text minute. We know the 1 hour, 5 for 5M, 5 minute, 5M, the 15 minute, and the 4 hour, which we're rating a 6 out of 10. So let's now take the replayer tool off and go to the current time. Okay, so you can see where now, by assessing the risk in this trade, we have been able to understand the constraints of this move, right? And we can assess the risk of all of these levels based on the architecture that happens here, right? We have the 4 hour level, which needs to hold. So this can, in theory, if what we're talking about with the risk guide, in theory, this should 4 hour level being a 6 out of 10 risk should allow you to stay in this trade for, I would say at least an hour. I would say, let's say at least 30 minutes. Let's say a 4 hour, at least 30 minutes. So let's use that as a minimum. So in the first 30 minutes, you need to either develop a criteria here or move away from this trade completely. So when you're in this trade and you have a 1 minute trade, you have to start developing that higher criteria. And we have allotted ourselves a bigger amount of time because we assess this as 6 out of 10. I just kind of picked a number out of my head here. 6 out of 10 for a 4 hour level seems reasonable. I don't think it's super risky to be buying 4 hour levels. And I think you need to allow them time to develop. They're not 1 minute levels that are the final pieces of a move that a 1 minute candle can snap down a 1 minute level. Like if this purple line here wasn't a weekly, but rather it was a 1 minute level inside of the range. Well, you lose that 1 minute level, it's only going to take 60 seconds to lose it. So you don't have a lot of time, right? So again, a 4 hour level here, yeah, I see that it can allow some time to develop. And as you go through this trade, you create a 5 minute hold level here, which is right here, which ends up manifesting itself into a 15 minute hold level. And therefore just completes your risk story all on its own. You don't even have to do anything. You've actually just taken the 4 hour level. You found the 1 hour range inside of it. And if you want to attack this 4 hour level again, if you want to sit here and constantly attack this 4 hour level, the next part you're going to go to is either the 5 or the 15 minute. In theory, you should go to the 15 minute because you've hit the 1 hour. You should go to the 15. If you had the 5 deeper than the 15, I would say that you'd have a possibility to hit this 15 like this through the 5 and then use that 15 as a reverse in the future. But in this scenario, we've hit the hourly. We can target the greedier level, which is the 15. So as you hit play, you target that 15. And that 15 minute level, I would say this is I would say this is getting to be pretty high risk. I would say this is getting to be like a 9 out of 10 scenario. It's not quite the 1 minute level or the, the 5 minute or 3 minute level. It's not, I'm sure there's one or two more levels in here. You still have a trend here. You still have to hard close this. So we know that it can't be a 10 out of 10 risk because it has to hard close over this weekly level here. So if this is a 10, this is a 10 out of 10 risk. The 15 minute level can't be 10, right? So we know immediately that this can't be a 10 out of 10 risk. And this is based on the architecture of the current move, okay? I think we can say this is an 8.5 because I think a 9, we can say this is an 8.5 because I think a 9 out of 10 risk would be underneath this trend, but above this range. Like, can we find a 1 minute level in here? Let's just go back here and just see if we can find something else. Not the 15 minute level. Is there like a 1 minute level in here or a 3 minute level? There's a 3 minute level right here. So this is a little greedier. Can't be this one because that already got tested. This backside gets tested. This front side doesn't. So we can say this is a 3 minute. Do we have something even greedier that we could say is a 9 out of 10? Let's take a look. Yeah, we do. We have this right here, which is the 1 minute level. This one is already tested right there. This one is never tested at all. We can use the body or the wick here. We'll just use the wick. That's fine. Call this a 1 minute. 9 out of 10 risk. So now we can go back to this move. Let's get to the front side of our chart here and take the replayer tool off. Go back into this jambalaya of levels we have, and we can see how this is now an 8.5 out of 10 because it's not quite a 10 out of 10 risk. Again, that would be above this trend threatening to hard close. There's a little bit deeper inside of this range this thing can go. It's the 15 minute hold level. We can delete the 5 minute. We don't need that. It can go deeper inside of this 15-minute range. It can go to the 1-minute level. So if the 1 minute is 9 out of 10, above the trend is 10 out of 10 risk, we can allow this trade. Yeah, I would say 15 minutes, 8.5. I would say we could like 15, 20 minutes to develop. And if we go here, let's see how much time we get. Well, you don't even need 15 or 20 minutes. You have the development of your level right here. I'm not sure what this gray one is, but we can remove that. Go to the replayer in this moment right here. Let's go right here. You take this trade, you know you need something to develop. So now we have to work forward in time. We have to say, okay, at a minimum, we can delete this. We'll keep the 1 hour. At a minimum, we are needing this level right here as our 3-minute, right? 3-minute. This is going to get real confusing. So I'm going to make these levels pink. Every level now on is going to be pink. And they're going to be on the left side of the screen because we've got a lot of stuff going on top and left instead of bottom and right. So top left pink, and pink as the color is the current development that we need. The 5-minute, we need to develop the same level. So we can actually just adjust this to the 5-minute. We don't even have the 3-minute there. We can just use the 5-minute. And the 15 maybe is, oh, we actually have all of that marked together. So we actually have a 15 right here as well. That's great. We have all of these that we need to gain, and that's relatively close. So in this, we know we have to reach this, start hard closing below these levels. Like we need to start being on this side of these levels in the next, let's say 15 minutes. So we've got entered the trade, or, hopefully you've entered the trade that's very close. I think you're within, a few dollars here. You're within such a, I don't even know if this is measurable. 0.4, yeah, close enough. Let's see if we get here at under 20 minutes, because if we can't, we need to get out of this trade. If we start lingering around here for 20 minutes without gaining these levels, we just got to get out of the trade. It's as simple as that. 1, 2, 3, 4, 5, 6, 7. Yep, you're already there. You're good. You don't need to do anything else. You've already gained your levels. Have you actually gained it? Yeah, you've already gained the levels here. So that gives you a perfect idea of how to use risk assessment in the moment to make that decision. And then this can be your shield. So now what you can do is you could just take this 15-minute, and I think I would use the 15-minute here as my shield. I don't think I'd go any deeper. And I would say this is my 15-minute shield. If I start hard closing the 15-minute time frame on this, where I assess the risk prior, I can now convert this into my shield on the trade. Let's color this as well pink, and we're going to put the text in the middle. And this is now my 15-minute shield in the trade. So if I had entered short right here, I can protect my account. Not only was I able to justify my entry in this trade based on timing factors and risk assessing it prior to entering the trade, I was then able to create a shield in the trade. So if I hard close over this in the future, I can get out of this position here unscathed, still in profits before this move snaps up and breaks, or at least gives me the chance to reshort back up in a higher risk scenario where I have even more control. So really what we've done is we've created the ultimate control, therefore tying all elements in, assessing risk and converting risk to shields to give yourself the ultimate reasons and time factors in terms of entries and exits, and to give yourself protection in the trade, therefore completing the risk guide. Wow, that was a big one. Again, can't possibly go over every single scenario, as you can see how elaborate this gets, but this creates the ultimate toolkit for assessing risk and really thinking about trading in a very different way. And one of the benefits here is that we're able to do all of this analysis prior to these moves happening. We're able to analyze this risk prior to the move happening, which gives us the exact queue of actions of what we need to do going forth in the future in these trades. It gives you the exact timing if you were to enter these trades like this. If you're sitting here in these trades and saying, hey, like let's delete that. I've already tested these levels. If I'm going to enter these trades in here, how much time am I even allowed to be in them? You've got your answer because you've done your risk assessment. And then the beautiful thing is you can then use your risk slider. And that would be your next part is and we did it without talking about it. But what we did is we allowed our trades to change this as a scalp, right? Everything starts as a scalp. So there has to be a point in the trade where you create a shield and that risk goes down. Just like how we did it in segment 2, this may be a 15-minute shield, but the risk is now getting lower as well. So always remember that this is starting as a scalp trade with the constraints of time that allow you to understand how long you're allowed to be in the trade, the moves that you have to develop given the amount of risk, and those being shields in the future will affect, and this is supposed to be one of those equalizer or music sliders, will affect what may have started as an 8.5 risk scenario can then be moved and slid down to maybe a 6 out of 10 risk scenario, which allows you to stay in the trade longer because now you've just said this is a 6 out of 10. It's more of a swing trade. And as time goes on and you develop bigger shields, maybe we can go to this hourly here and find the origin level. And if you were to, well, there's no origin level there. Let's maybe go to the 4 hour. If you were to say, gain this level as a 4 hour level, this might be the perfect point that gives you a position trade where as long as you don't break back above this, right? So what you've done is you've said, this is a 4 hour level. We have moved below it. We have hard closed the 4 hour around here. This is a position trade because now you can move your slider. What would have been a 6 out of 10. Now you can move it to like a 2 or 3 because your entry was so premium up here. You've justified it was actually higher. It was like up here. You've justified the entry. You've created your shield. You've now created a bigger 4 hour shield, and you can therefore adjust your risk slider appropriately from what started as an 8.5 out of 10 right here. It then slid down to a 6 right here. It gained, which was this moment here, the 15-minute shield. It then gained the 4 hour level here. I'm not going to use this candle, although theoretically it should be this current yellow candle. Let's just use this one for this example, just because we don't know if this is closed yet or not. And I don't really know what the replay tool is showing us here either. And you're really, okay, so this is here. And now you've developed a perfect position trade where you should sit in this as a position trade. And that is a big mess. So we're going to end it right there. Thank you so much for tuning into this risk guide. Again, this is a very new way to look at risk. Everything we do with My Science and everything that I do is to change the way we look at day trading in a modern way and to reinvent day trading for a new generation of people. And, the year is 2022 and there's a lot of stuff happening in the world. And it's really important that we as human beings evolve and always take these opportunities to create new ways in which we can see the markets. Now, of course, I've got to say this in every single video. Subscribe to the channel if you like what I do. Like this video, pass along the knowledge and spread the word. And of course, you can join my Patreon as well. I have a great Discord community. I have Patreon exclusive content that I do every month. There's a ton of stuff going on. And best and the most interesting thing that we do is the Discord community. It's a crazy, crazy, amazing community that constantly helps each other evolve every single day. We have people of all levels there, beginner, advanced, pro, people who are making nothing in day trading and people who are making 7 figures a year in day trading, all and everything in between. So if you want a great place to call home, join the Discord community. It's accessible by my Patreon. And until the next time, we'll see you on the next video. Cheers.